Okay, chapter 2. Now we're going to start recording the transactions, everything that we saw as a transaction. So what we learned from last time? Last time we learned that accounting is not just one function. It's a few functions involved all together. So what we're going to do through the accounting, the process of accounting, we're going to gather this information. We're going to put that information on one place. We're going to analyze the information. We're going to prepare the reports for the decision makers. Again, the accounting is the entire system which helps us to identify the transactions or events that are happening, record it on one place, analyzing the recording, prepare the reports, and give it to the users, they to make their decisions. For the point of view of the users, we have two types of accounting. One was the financial reporting, the other one is the managerial accounting. Financial accounting or financial reporting is directly specifically for the people who wants to make either investment decisions, either decision to in terms of credit point of view. So they have money, they want to lend the money to the company, they're looking for interest. Where the investors, they have extra money that they don't want, but they want to make more money. So the one who investing in the company. The whole point with the difference between the investors and the creditors you should look is that the investors are more concerned if we have to put it in that category, who is more concerned about the health of the company, the investors or the creditors? Investors. Why investors? Because the investors is the one that relying only on the profit or the positive earnings of the company. So what they expect the revenue to be more than the expenses. As long as the revenue more than expenses, then the company generate earnings in forms of net income. So that's the investors look for. Where the creditors to some extent they're protected. Even the company not making money, the creditors are protected. That means they're going to get their principal at least. Most likely they're going to get the interest as well. So for the managerial accounting is more interesting from my point of view. It doesn't have to be always my point of view. You may find it a different way, but for me, managerial accounting is more interesting because the managerial accounting, again, looking at the event that happened in the company, we are going to analyze those events and going to prepare a plan what we can do in the future, how can we change the future in order to get new results which are different than what we're seeing right now. That's why for that purpose, I like managerial accounting better because managerial accounting is oriented on the future, where the financial reporting is mostly oriented to what's happened in the past. So the other thing that we learn is all the accounting that's transaction and events and everything. In order to record it, we have to follow some rules, and those rules are based on some framework, if you can put it this way, based on some rules, which rules form the foundation of the accounting. So in order accounting information to be useful, it has to be reliable, it has to be comparable, it has to be understandable, it has to be verified. And we're achieving those with different rules that we have following under the accounting. Also, we have some general rules, which is going concern, which is also economic entity perspective, which means we only recording transactions which are related to the business or to the entity, not transactions which are outside of the business or the entity. And then we talk about the materiality a little bit, and we talk about the cost and benefits of the information. And then we start preparing the simple transactions, which are in the line of the basic accounting equation, assets equal to liability plus equity. Or, in other words, everything that the company has or company possess at any certain point either belongs to the creditors, either belongs to the investors, which are the owners of the company. And today what we're going to do, we're going to expand this analyzing of transactions, and we're going to find a new way to record those transactions. Now the question is, how can we record the transactions and what we're going to use for that? So first, let's see the accounting cycle that we're going to cover. We're going to cover this accounting cycle, believe it or not, up to the midterm. So on the midterm, you're going to see everything on the accounting cycle. So accounting cycle first start obviously with balance, which is the current situation of the company. Then the events start happening. They're always a starting point. After that, the events start happening. Which is the event? The event is we have to identify and analyze the transaction. Is this transaction part of the entity? Is it part of the business? Do we have to record it? And if we have to record it, we're going to record that transaction in the journal. Journal is no different than a notebook. So some of you may have your accounting inside your pocket. Why? Because you're doing every time when you get the money, you make yourself a note. This person pay me this one, and every time when you spend the money, I spent out of those money that this person pay me. I spent for this, I spent for this, I spent for this. So currently, I have that much. In the accounting system, what we're gonna do once we make that record in the journal, then we're gonna post the journal into the ledger account. Ledger account will be all accounts combined together. And then we're going to prepare this unadjusted trial balance. The trial balance will be simply now on one sheet, one list. We're going to see all the accounts with all the balances, and we're going to see how much of each assets and how much of each liability and equity we have. Then we're going to put some adjusting entries. Adjusting entry usually comes at the end of accounting period or end of the year. Then we're going to prepare adjusted trial balance, financial statement. Then we're going to close some accounts. We're going to see which accounts we're going to close. And then we're going to prepare the final trial balance. And we're going to start again. And that's our objective in the numbers of the circle and which part of the circle we are. So in summary, what we're going to do is today we're going to see step 1 to 4. Then next time we're going to see step 5, 6, and 7. And the last thing is in chapter 4, we're going to see the last 5, 6, and 7, the last two steps 8 and 9. That's our objective. How are we going to achieve it? With more knowledge. First, before we start, the accounting system is organized in everything in the system is organized simply as an account. What can you relate the account? The account will be let's pretend we have a what will be that? Closet. Which closet has a different drawers. So every drawer will use it for one purpose and one purpose only. Inside of every drawer, we're gonna put a sheet, and every time when you put something in the drawer, we're gonna make a note what we're putting. And every time when we take something from that drawer, we're gonna write down what we're taking out. So we're always gonna know how much we have in the very beginning when that closet was put there, and how much we currently have after everything that we put and take out from every single drawer in that closet. So the drawer will be our account. The journal will be the sheet that we have in every single drawer on which we chronologically is going to record everything that happened to that particular drawer. What's coming in, what's going out, what's coming in, what's going out. And that will be recorded again, chronological order of everything, all the transactions. Then the ledger will represent the entire closet. Because in that closet, we have all those drawers which are our accounts. So the ledger is going to be one place that we have everything all together. Then what will be the trial balance? The trial balance will be the sheet which is sitting on the closet, in front of the closet, which tells you, in the first drawer, you have this. On the second, currently, at this moment, at the second drawer, you have that. On the third drawer, you have this. On the fourth drawer, you have that. So that's how we're going to organize all the information that we're going to have. Every drawer, again, will be present a count. In the count, we're going to identify the changes coming in, going out. What is those changes we're going to be? Put on the journal. Through the journal, we're going to record the transactions which are related to that particular account. Then all the accounts together will be combined in the ledger, and in front of on the top of the ledger, we're going to have this trial balance, which is going to tell us in which account how much currently we have right at this moment. If something changed, trial balance is going to change. Why? Because we're going to make a new journal entry on the journal, or on the sheet in the drawer, we're going to make changes. That will reflect the whole closet, and on the trial balance, we're going to have the new content on that particular drawer. The other way you can look at this is as an accounting as a whole system. You can simply see it in the, there's a refrigerator now. I don't know if you noticed, but there are refrigerators which in front of the refrigerator, obviously there will be active connected to internet screen, which you can see the weather, watch the news. But the other thing that you can do is you can choose the recipe. So what the fridge is gonna do for you is the fridge is gonna look inside the content that you have in the fridge. From the recipe that you're choosing, which ingredients you have, how much you have, and if you don't have it, which ingredients you have to purchase. And what the fridge also can do is he can place the order in the store for the ingredients that you don't have, or at least give you a sheet list, which will list you're going to see it on your cell phone, that what you need in order to get the recipe that you just look at. Now, this is too advanced system, but pretty much that's the accounting doing. So basically, what the fridge is looking is what you have inside the fridge, what's the quantity, what was put in, what was taken out, what's the current situation. And when you see that, let's say I'm looking to lettuce, and when you click on the lettuce, the fridge is going to tell you history of what the lettuce, that will be the history of account. Start in the very beginning, you didn't have any lettuces, but after that you purchased that much, you use that much, you purchase that much, you're using that much, and right now you have that much, which is not going to be enough for one salad. So if you want to make a salad, you have to purchase that many more. That will be on the fridge side. On the accounting, we're not going to make that extension. We're going to simply say, okay, during the period you purchase this, you use that, you purchase this, you use that. Currently you have that much. So how much you have is going to be shown the trial balance. If you want to see from where that came from, you're going to open the ledger. If you want to see what's happened in certain account, you're going to take a look at the journal and you're going to see all the transactions. So again, different accounts, it's going to go to that ledger. For every account, we're going to have a journal, which is going to tell us what's happened in that particular account. So for the cash, for example, you're going to see the trial balance and you're going to see cash, you have $1,000. And then you're going to see from where did you find that $1,000? Now you open the ledger and you're going, you have to find the account cash. You open the ledger, you found the account cash. In the account cash, you're going to look at the journal and see what's happened with the cash. And you're going to see on the chronological order. On May 1st, you get this. You paid by the employer. After that, you pay the credit card, you pay the cell phone, you pay the electricity, you pay for this, you pay for that. And right now, currently, you have exactly that much money, which much money is sitting on the trial balance. And you understand, okay, now I understand why I have in $1,000. Because those things happen. Same thing with the next account. You see on the trial balance, accounts payable tells you that currently I have to pay $50. And you're wondering, what? Why? Open the ledger, go to the accounts payable account, and you're going to see. You received the invoice from Tellus, you paid it. You received the invoice from Rogers, you paid it. You received the invoice from Shah for $50 for the internet, you haven't paid it yet. Oh, okay, so I have to pay the invoice. Yes, I understand now. That's the only purpose of the accounting is accounting was created. I don't know if you follow the history, it was created in the Florence. It was created by a monk. The whole accounting system was created by a monk. And the only reason why he created the accounting and created the journal double entries, which we're going to talk in the second, the double entry is, the purpose is to help the people to understand what they have, from where that came from, and if they owe something, to whom they owe it, and how much they owe. Again, the accounting is created initially for helping people. Now, people using it also for help, but for different purposes. Now, in order to have this account, obviously we have to have many accounts. What kind of accounts we're going to have? Depends on what kind of business we're running. Depends on the assets that we have. So once we once we open the business, as you can see, we cannot operate if we don't have assets. So first thing what we have to do is to get the assets. In that case, we're going to look at which is the asset that is the most common asset, and I can convert it to any other assets instantly. Simple answer will be cash. So in order to open the company, since I'm starting my company, I have to start my operation. Either it's going to be selling the items, or it's going to providing services. Those are the two options that you have technically. Selling goods or providing services. So the question is, can I provide services with cash only? What can I do with cash? Pretty much nothing. I know most of us, we want to have cash, but can you cover, if you're cold, can you cover yourself with cash? No, you can't. If you're hungry, can you eat cash? No, you can't. Especially in Canada with this plastic money, you're gonna choke right away. I mean, in some countries, they're making like a paper money. Oh, yeah, those one, I can see you kind of swallowing. And if you put it in the water, you can come up with some color and anything like that. That's okay. You can make a stew with that. But that's where we are. So what's the cash used for? Pretty much for nothing. But you can convert it for something which is useful. With the cash, you can buy a grocery. You can buy another assets. Which assets you can use. And now you can generate what you want. So let's say we're a restaurant. We're not when the customer comes and say, "Can I have soup?" You're not going to give him soup of cash. You're going to give him a soup with some ingredients. So basically, with the cash that you're generating, you get it, you invest it in the company. In the first place, you're going to buy the ingredients. We're going to open the restaurant, and we're going to serve the people food. Don't get me wrong; they're going to pay us cash, which the cash again we're going to convert it to a different type of assets, which we're going to provide. We'll cook something, and we're going to give it something again. We're going to provide that services, that food, and they're going to give us more cash. And we're going to still go doing the same thing. So the question is, do we have to keep track of all the assets that we have? Since cash not going to be the only asset. Yes. For that reason, so let's continue with that the previous idea with the, so we have to keep track of assets. On the other side of the equation, we have a liability and equity. Do we have to keep track of all the liability that we may have or all the money that we owe? Yes, we do. Do we have to keep track to whom we owe the money? Yes, we do. So again, so we have to keep track of the assets, we have to keep track of the liabilities, and what else? We have to keep track of owners, because with the assets that the company has, they came from because the company owes money to the outsiders and the company owes money to the owner. So we have to keep track of those. So what else we have to keep track? We have to keep track of how much money the customer pay me, how much services provided, and how much money they pay me. And the other thing is, what we have to keep track of, in order to provide those services, what kind of expenses I generating during the process of the business. Because at the end of the day, how are we going to find out if you're profitable if you don't keep track of the revenue that you're generating from your services and you not keep track of the expenses? It will be impossible. So for that reason, we're going to keep track of all the revenue that we're generating through the normal operating cycle or the normal business. And we're going to keep track of the expenses that we're generating in order to generate the revenue from the customers. How are we going to organize this information? Very simple. We're going to put the numbers. We're going to use the number system. We're going to use the Arabic numbers, not the Roman numbers, Arabic numbers. And with number one, we're going to put number one. When you see number one in front of the account, that will be assets. All the assets accounts, we're going to start with number one. Then with liability, since asset is equal to liability plus equity, asset will be number one, liability will be number two. So every time when you see account starting with number two, that will be liability. And since the asset is equal to liability plus equity, then number three will be for the equity. Now, what also we know? We know that the revenue that the company generate increase the wealth of the owner or increase the money that the company owes to the owner. So for that reason, we're gonna use for the revenue number four. And then for the expenses, since we know the expenses reducing the owner's equity or reducing what the company owes to the owner, we're going to use number 5, number 6, number 7. So once we go to the class, first thing that I'm going to do is I'm going to give you a chart of accounts. It's called chart of accounts. It will be on the one page and it's going to be a little bit hard paper so it can stay longer. And I will ask you to keep that sheet of paper all the time on your desk during the exam, during the tests. Every time when you need it, I want to see it in your possession so we can discuss it. So it's not going to be the final version. It's always going to be a room for the interpret to adding more, but it's going to be more like a starting point. That's how you have to see this paper. So that sheet is going to look like this. We're going to have organize all the possible accounts that you might see or you may see in the company. So again, it's just very general. It's more like informative for you rather than prescribed. So with number one, always going to start the assets. Every time when you see account starting with number one, simply think assets. Now, what kind of assets we're going to have? We're going to have different assets, but we're going to see a little bit later for that. We're going to have current assets, we're going to have long-term assets, we're going to have property, plant, and equipment, we have the intangible assets. Next thing that we're going to have, number two, comes for the liability. Remember, the accounting equation is assets equal to liability plus equity. So on the balance sheet, balance sheet will be one of the statements. We already saw the balance sheet, we're going to have only the accounts. So we're going to come a little bit later with the accounts which have a balance, which will be the assets, liability, and equity. So number two will be the liability, reserved for the liability. Number three will be reserved for the equity. Then we're going to have accounts which are related to the net income or increase the owner's equity. So what will be the first account? First account will be the revenue accounts. As you can see, we're going to have some revenue accounts, but there's not many. However, in order to generate that revenue, we need expense. For the expense, since we have so many different expenses, we're going to keep track of every single expense that the company has to generate this revenue. So first we're going to have this section which is cost of goods sold. That's when we are merchandising, or even if the service company, we're going to come up with the idea how we're going to get the cost of goods sold, which is the goods and services that we're providing through our normal operating cycle of the company. And then we're going to have all the other expenses which are related to supporting the business. And those will be starting with starting with 5, then we're going to have number 6, number 7. You can even go with number 8 on the expense account. That's how many expense accounts we're going to have. We can have a lot of expense accounts. Why? Because more you have, more you're going to understand about the business and from where you're generating the revenue. Okay, let's go back to the slides and continue with the slides with the numbers, with the account numbers. Again, 1 assets, 2 liability, 3 owner's equity, 4 revenue, 5 expenses. This is another example for you to see it on the balance sheet. Since asset is equal to liability equity, we're going to have 1, 2, 3. Income statement, we're going to have 4, 5, 6, 7, 8 expenses. Now let's go with this idea with the debit and credit or double journal entry. So now in the accounting, or let's go back to our closet, right? In our closet. So in our closet, we're going to keep it closed system. Means that if something go to the drawer 1, that has to come from somewhere, right? So for that reason, one transaction always going to involve 2 drawers. So that's why it's called double entry system. So every transaction is going to affect at least 2 accounts. Can it affect 3 accounts? Yes. Can it affect 4 accounts? Yes, it can. There will be receiving side and spending or giving side. For example, one will be the cash. Again, cash. Let's think about the cash. So what's going to happen with cash? Company open. When the company opens, does the company have cash? No. From where are we going to get the cash? Let's see the accounting equation. Assets equal to liability and equity. So either we have to borrow, either we have to get somebody to invest. Bank's not going to give us a loan because we don't have any assets. Doesn't matter how good idea you have. Bank not going to take the whole risk. They want somebody else to take the risk first, and they can take part of the risk. So who's going to be the person who taking risk? That will be the investors or the owner of the company. So what we have to do, he has to invest the money, because only with cash we can buy other assets, which is going to help us for our operation. So the owner invests cash. So what's going to happen in that case, that the double entry will be cash is going to increase on one side. On the other side, owner's capital is going to increase. Now with the cash, we're going to purchase supplies. Now, before we purchase the supplies, we have cash only. Once we purchase the supplies, we're going to have supplies, but we have to sacrifice some cash. So supply is going to go up, cash is going to go down. If we have to purchase the truck, yes, we're going to purchase that truck. Why? Because we need it for our operation. We cannot operate. We cannot do the, let's say, pickup of the garbage from the residential area without having the truck. So we have to have the truck. Otherwise, we cannot perform the services that we open the company for. Okay, so, but they have cash. Well, now we have to use that cash to purchase the truck. So before we purchase the truck, we have only cash, no truck. When we purchase the truck, we have now truck, but we don't have the cash. The other option is, if we don't have the cash, then we can promise the dealer that we're gonna pay later. So what will be that for them and for us then? That will be liability. So we can have increase in assets in form of truck, and then we're going to have increase of liability in forms of loan. So let's see how we're going to do this. We're going to do it through simply T accounts. What is T account? So let's go back to I'm going to open here one Excel spreadsheet and I'm going to work with the Excel spreadsheet so you can get a little bit more ideas about T accounts and how the T accounts work. In order to do that, I have to open this Excel spreadsheet. Let me share my screen and we're going to start, just for the time being, we're going to move to that Excel spreadsheet. Can you guys see my screen?
Yes.
Okay.
Yeah.
So what we're going to have is, first we're going to start with the basic accounting equation. Let's start with this basic accounting equation, because everything comes from the simple fact that the assets are equal to liability plus equity. Simply, the money that you have in your bank account either belong to somebody else, either belong to you. The other way you can say it, with the money that you have in the bank account, once you pay your outstanding debt, the rest is yours. So now we have to keep track of those. How are we going to keep track? With the T accounts. We're going to start open those accounts. What will be T account look like? Something like this. Now at this point, we are in the balance sheet account. So basically, once we have keep track of the assets, liability, and equity, we keep track of the everything that we have. Those accounts are going to have balance. Now they're going to have beginning balance, and they're going to have ending balance. Since they have beginning balance and ending balance, we're going to call them balance sheet accounts. So we're going to have balance sheet for accounts for the assets, and we're going to have balance sheet for the account for the liability and for the equity. Now, what will be the interesting? Each account is going to have debit on the left side and credit on the right side. Like same thing here, debit on the left side and credit on the right side. Now, where will be the balances? Now, as long as we are on the asset side, on the left side of the equation, all the balances will be on the left side of the account, which will be debit. So that will be the beginning balance will be here, and the ending balance will be on the left side. And once we move to the right side of the equation, that's going to affect our balances. So in that case, the beginning balance is going to be on the left side, and the ending balance is going to be on the right side. Why? Because we simply on the right side of the equation. So do you have to remember this? At this point, no. But you have to be logical. So what you can do is the T account, as you can see, is aligned with the T. Looks like a letter T. That's why it's called T account. One side is left side, the other side is the right side. Left side is always debit, right side is credit. So do you have to remember that the assets usually is going to have normal balance debit? No. Do you have to remember that liability equity usually normal balance have credit? No. What do you have to remember? You have to remember that accounting equation, that assets is equal to liability and equity. Then if you're having problem to remember which account is starting with which balance, what you have to do is draw the T account for the equation. Use the equal sign to draw the T. Everything that stays on the left side of the equation has normal balance debit. So everything that stays on the left side of the equation has normal balance debit. And everything that stays on the right side of the equation is going to have normal balance credit. So which are the accounts that are on the left side of the equation? We have only one type of accounts, which are assets accounts. So all the assets accounts are going to have debit balance. On the right side of the equation, what we have liability and equity. So all the accounts which are related to liability and equity, we're going to have normal balance credit. The other thing that I want you to understand is on the assets accounts, every time when we add on the debit side, that will increase the account balance. It's not going to let me, so I have to do this trick here. Every time when we add on the left side, on the debit side, that's going to increase the balance of the account. And every time when we write something on the right side, that will be credit, so that will be decrease the account balance. But that's valid only for the asset accounts, since their normal balance is debit. On the liability and equity, since their normal balance is credit, now what we're going to do is we're going to flip this opposite. So every time when we put something on the credit side, that's going to increase the liability equity account. And every time when we put something on the debit side, that's going to reduce the liability or equity. So let's see a simple example here so you can understand it. The simple example was the owner opened the company. So this one will be, sorry, the opposite. This one's gonna come here, and this one's gonna go right here. So we have to do these adjustments here. And now it looks right. So every time when we put something in the credit, that's going to increase the balance. Every time when we put it on the debit, that's going to reduce the balance. And I'm going to grab this one now for the liability and equity, and I'm going to put it right, should be right here. And let's delete one line so they can be exactly in the same location. Okay, so imagine this one is cash, and this one is the capital. Cash is the asset account, and the capital is the ownership account or equity account. So if the owner decide to invest $10,000 in the company, we're going to put it on the debit side, or our cash going to increase. But that also is going to increase the capital, which has to be on the other side of the equation in order assets to be equal to liability. But since we're doing the double entry, every time when you see debit, there has to be a credit. And since when we put 10,000 here, it's going to increase the owner capital in the company. Seems the right place to be. So what's happening in this transaction? Owner invested 10,000 and the company owes the investor 10,000. So his capital increased with 10,000 and the company cash increased with the 10,000. So company raised the capital from the owner of the company. And then we're going to see more and more and more transaction with debit and credit, and you're going to see the idea. Now, the other thing that I want to see right now is, let's take a look at one debit account. Let's stay with the debit account, and let's put the debit account, and let's stay with our cash. That will be a good place to start. Let's do some thinking here. Imagine this. Very, very, very simple thing. Imagine you have in your pocket $20. You withdraw, you want to go to Metro Town for shopping. With $20, you're not going to buy much. So you're going to ITM and you withdraw from your bank account and you put in your pocket $100. So you had in your pocket $20, you withdraw and put another $100. You went through Metro Town and you spent $70. How many dollars you have in your pocket? What you gonna say?
I mean, you had to spend that money from somewhere else because.
So how much you have? $50.
Yeah.
How did you get the 50? 20 I have. 100 I withdraw. 70 I spend. 50 I have. So how did you get it? Well, simple calculation is beginning balance plus the debit or whatever you get is always equal to credit or whatever you give plus the ending balance. Let's see if that is true. If this equation works. So beginning balance was 20. We withdraw 100. Then we spent 70. And the question was, how much was ending balance is equal to what? If we have to express it, it's going to be the ending balance going to be equal to 20 plus 100 minus 70. And that's how we're going to get that 50 that you told me. Is that how you did it? Is that the logic that you did in order to tell me 50? Okay. Now let's change the question a little bit. We're going to change the question a little bit. You started with $20 again. You have in your pocket $20. You withdraw, now let's withdraw 200. You spend what you spend in Metro Town, you'd have no idea how much you spent. But you're going home and you found in your pocket $40. How much did you spend? So let's see how we're going to solve this. Again, we're starting from this. Beginning balance plus the debit is equal to credit minus the ending balance. How much was our beginning balance now? 20 plus 200 coming in. Now, we don't know the credit. We're trying to find how much we spent. Credit, we have no idea how much is it. But what we know is how much is our ending balance. And the ending balance was $40. So what we have to find out? How much is the credit? So the credit in this case, it's going to be equal to 20, which is the beginning balance, plus 200, which is coming in, debit, minus 40, which is the ending balance. And once you solve this equation, it's going to be, this calculation is going to be 180. Make sense? Are you guys with me? How difficult it is? Do you know what's the reality? This is how difficult accounting is. That's your accounting people. When people say, I'm so scared of accounting, that's what you're scared of. Either to find out how much money you have to have, either left in your pocket, either you calculate how much you spend. That's your accounting. Nothing more, nothing less. So if you think that this is difficult, then you're never going to find out how much money you're going to have in your pocket, which I know you already know. So how else we can translate this? We can translate this in so many ways. Today I was on with I had to do some massage. With the massage therapist, I told him this, how simple accounting is, because he was also thinking accounting is difficult. So I told him, listen this, imagine you're going to the weight measure and you're measuring your 60 kilograms. But you want to be 55. So you have beginning balance, you have the ending balance. How can you achieve that? Very simple. Make sure that what you put in here is less what you're getting out. So if you're 60 kilograms, and you want to be 55 kilograms, the amount of the calorie that you intake, it has to be less than the amount of the calorie that's going out. So if you take 200 calories, make sure you're spending 205 calories. If you do that, you can reduce your weight. More you're putting, less you're spending, more you're gonna have. That's how simple it is. I mean, you want, so now let's go with the cash. Now, if you have $60 in your bank account, but you want to have $100 in your bank account, what you have to make sure? The money that's coming in are more than the money that you spend. If you want to increase your cash balance, you have to spend less than what you're getting. As long as you achieve that, you're going to get that extra cash. If you're spending more than what you're getting, I'm sorry, there's nothing I can do. Even if I want to, I can't. So the other way to see the accounting is open your fridge. Every time when you open your fridge, you see the beginning balance. Let's do this exercise. You open the fridge. You're seeing you have 2 liters milk in your fridge. You know it's Friday, and you know it's long weekend coming. Your kid's drinking milk. You're going and buying a new jug of milk, which is 4 liters. At the end of the long weekend, on Tuesday, you're opening the fridge and you're seeing 1 liter milk left. How many liters milk your kids drink during the long weekend? Everybody see the 5 liters? That's your accounting, people. I can give you another example with the accounting. You're buying in the Costco, they're selling lettuce, 8 lettuces in 1 pack. Before the long weekend, you bought 8 lettuces. You put it in your fridge. You didn't have any lettuces before. You put the 8 lettuces. At the end of the long weekend, you're looking, you have only 3 lettuces left. How many lettuces you eat during the long weekend? 5. The other question will be, you put 8 lettuces, you eat 4. How many you expect to see in the fridge? 4. Make sense? 8 minus 4 is going to give you 4. That's your accounting. So now, if you have to do the same thing with the liability, pretty much exactly the same idea works, but in the liability, we're going to do some adjustments here. What we're going to do? Now, since it's a liability, sorry, not this one, we're going to have C and then V. On the liability side, imagine, in the very, very, very beginning, you didn't have a phone. Once you start, you didn't have a phone. If you don't have the phone, you don't have to pay the phone bill. Perfect. But, so your balance starts with 0. But you purchase your phone. The first bill comes. You're using the phone, that's your expense, and the bill comes. You haven't paid yet. So what's going to happen? Your liability is going to increase. In 24 days, you have to pay that invoice. So every time when you pay the invoice, your liability is going down. So in the very beginning, if you haven't paid the bill, your liability will be $50. But once you pay a liability, your liability is going to go down. Make sense? All right. If this makes sense, let's go back to, but in here, what we have to do, we have to make some adjustments. Let's cover this one and then we're going to move on. We have to make some slight adjustments in our formula. What will be that? In this case, now we're going to have beginning balance plus the credit now. It's going to be equal to the debit minus the ending balance. Why is that? Because we are on the right side of the equation. The liability and equity normally have credit balance. So every time when you go on the credit, the balance increasing. Every time when it goes to debit, the balance decreasing. And the beginning balance here on the capital and will be on the other side. This one here will be beginning here, and the ending is going to be on the right side. Let's make this change. That will be the last change that we're going to make, and we already know which one is the liability, which one is the equity. Let's change it here on those one as well, so not confusing you. I'm going to post to this one so you can have it for your own purposes later. And now it makes sense. Beginning balance plus the credit is going to be equal to debit plus the ending balance. Plus, that's plus, not minus, plus the ending balance. So now let's move back to the slides and let's continue with the slides. Let me share my screen. So sometimes what I'm catching myself is sometimes I'm start talking and I haven't shared anything with you. If that happen and you see that I'm talking, but I'm not sharing anything, please make me send me a text, something on the chat. I'm trying to monitor in the chat while I'm talking, so I can see where I'm trying to see all the time to see what's the screen that you're looking and what you're seeing. So now let's go with the T accounts again. The T account on the left side always going to be debit. On the right side always going to be credit. It's nothing like a good and bad, it's just debit and credit. That will be the quick effect of the transaction in particular account. And again, debit is on the left side, credit on the right side. From the accounting equation, assets equal to liability plus owner's equity. When you draw the T account, you're going to see debit on the left side, credit on the right side. What that means? That means the assets account. Normal balance is always debit. So everything that comes on the debit side is going to increase the asset, and everything comes on the credit side is going to decrease the asset. On the liability and equity is the opposite. Normal balance will be always credit. So that means every time when we put something on the credit side, it's going to increase the account. And every time when you put something on the debit side, it's going to decrease that account. That's with the assets and liability. So let's see here the simple thing. Owner invested 25,000 cash. What's happened? Cash going up. So we're going to debit the cash account since the asset. Owner's capital also goes up. So we're going to create the owner's capital with the same amount. Then, again, the cash is cash. We cannot use it, but we want to purchase land. To purchase the land, we're going to use the cash. So now what we're going to happen is one asset is going to convert to another asset. The cash is going to convert to land. So the cash is going to go down on the credit side, and land is going to go up on the debit side. Before we purchase the land, we have 2,500 total assets. Once we purchase the land, we still have 250,000 assets. How is that? Because we have 150 cash left and land for the same amount for the amount that we pay the cash, $100,000. That will be expression with the accounts. And to see on which transaction what's happened. In the first transaction, debit is equal to credit because, again, capital goes up on the credit side. Debit goes up. Cash goes up on the debit side, both increasing. Second transaction, we're flipping one asset to another asset. So one asset goes down, the other asset goes up. We're still in balance because the total assets is equal to the total equity in this case. There's no liability in this company. Not yet. So if we have to add on the owner's capital, remember in the owner's capital was affected by the investments that the owners make, withdrawals that the owners make, revenue that company generating, and expenses that company incurring to generate those revenue. So for that reason, investment capital is an equity account. So anything on the credit side is going to increase the capital. Anything on the debit side is going to decrease the capital. Withdrawal is some kind of special account, which is the opposite of the capital. Withdrawal account usually reducing the capital. So for that reason, the normal balance here will be debit. So everything on the debit side is going to increase the withdrawals. Anything on the credit side is going to decrease the withdrawals. Now let's see the revenue expenses, how they behave. Revenue, increasing the capital. And since the capital increase on the credit side, revenue, when it comes on the credit side, is going to increase, show the increase. On what? On the capital. So that's why revenue always is on credit. If you have to memorize something, revenue, credit. Every time when you hear revenue, credit. Why? Credit is good for the owner. Credit increase the owner's wealth. Revenue is good for the owners. Increase the owner's wealth. Credit. How about expenses? Expenses are not good for the owners. It's a needed evil, but decreasing the owner's capital. So for that reason, expenses is going to increase on the debit side. So usually the normal balance on the expense account is on the debit. And if it's on the credit, it's going to decrease the expenses. That's with all the type of accounts that you may see. So let's keep going now. The normal balances. Again, the normal balances, the simpler way you can understand it is draw the accounting equation. Asset is equal to liability plus equity. And think about it. Draw the T account through the equal sign. everything that stays on the left side, debit balance. Everything that stays on the right side, credit balance. Revenue, increasing the owner's equity, which is on the credit side, normal balance, credit. Expenses, decreasing the owner's equity, normal balance, debit. Withdrawal, decreasing owner's equity, normal balance, debit. For memorization purposes, memorize the accounting equation, assets equal to liability plus equity, T account, think. I usually not encouraging my students to memorize. I encourage them to think. I encourage them, they to come up with the idea by using the knowledge that they have. Memorization, leave it for the artificial intelligence. We are human beings, we have a brain. Artificial intelligence is created by the humans, doesn't have brain. Because it doesn't exist anyway. We have a privilege to have brain. We have a privilege to think. Be a thinker. Think. Don't memorize. Come up with the idea by using your brain. So analyze and record transactions in the journal entry. So what we have to do is, first we have to see what will be the document that's going to tell us that there's a transaction. Well, we can find a different source of documentation. For simple one will be the bank statement or bank deposit slip. Once we deposit the money in the bank, the ITM or the teller is going to give you deposit slip. What's going to say on the deposit slip? The money was put in your bank account. From where that money came from? From your own pocket. Where did they go? To the business. So what that means? The business get, let's say, $100 cash, which came out from your personal money from your pocket. So now the business owe you $100. Why did you put the $100? Because you have to invest in the business. So what will be that for you? That will be owner's capital. Then with the money that you have, you're going to purchase something. Okay? We're going to purchase something. What we're going to get? We're going to get the purchase invoice. The business from where you're purchasing is going to give you purchase invoice. To some instances, when you're purchasing on the superstore, pay attention. The receipts that coming from the cashier or from the machine serve as an invoice. Why? Because it has all the elements that the invoice should have. It has the name of the company. It has the GST number of the company. It may have even number. It has all the items that you purchase, number of the items, time, individual price per the item equal to the total, sum of all the totals, taxes added at the end, total with amount before taxes, total of taxes, give you the total amount due. Date of the invoice, time of the purchase, everything. Next thing that you can do is, next document will be the bank check. Bank check is when you're paying the invoice for which you get for the purchase. So the bank check will be, on the bank check, you're gonna see the date, the amount that you're paying, to whom you're paying, and you may even see the invoice that you're paying for. And the last thing is the sales invoice. Not the last thing, there's so many documents, different type of documents, but those are just general kind of type of documents. The other one will be the sales invoice. On the sales invoice, then you're gonna be your company name, plus the company that you're selling to, description of the item that you're selling or the services that you're providing, norm of the item that you're selling, time the individual price per the item, or the total of the services that you're charging, which service may come from the hourly rate that you may charge. So you can say 10 hours times $180 per hour, $1,800 plus the GST. or related sales and other taxes, and you come up with the total amount. So those are the source of the documents. How are we going to record those transactions? For the recording transactions, first we're going to use the chronological order. All the transactions, as you remember, on the journal entry, we're going to put it in the chronological order. What means chronological order? By date. We're not going to start with May 15th, then go May 1st, then going to go to May 31st, then going to go back to May 13th, then 22nd, and keep going. Not like that. Day by day. As you remember, or as you already know, or as you already noticed from your life, everything happens in our life in chronological order. For example, an age of 6 or age of 5, or it depends where you are, you started your grade 1. Then your birthday came, and then after that Christmas came, and after that you started grade 2. Then another probably birthday, Christmas, grade 3, and keep going and keep going. When it was grade 3, that what happened. When it was grade 4, that was happened. And everything is chronological order. Now, what will be the process of journalizing the transaction? First, we have to identify, do we have a document? On the document, is that related to the transaction? Second, if we identify, yes, this is a document, yes, that's related to the transaction, then we have to identify which accounts are involved. Are those the assets accounts? Are those liability accounts? What will be the proper name? How we're going to name it? And then we're going to see with this transaction, what increasing, what decreasing. Because if we have a sales invoice, obviously our revenue is going to increase and our assets going to increase, either cash, either accounts receivables. When we're paying to the vendor, our cash is going to decrease and our liability is going to decrease as well. So we have to find out on which side each decreasing and increasing, so in order we to do the right debit and credit. The other thing that we have to keep in mind is we have to keep the accounting equation always in balance. Means asset always to be equal to the liability plus equity. And we're going to do this with the journal entry, simply debit and credit. And we also going to remember, debit always have to be equal to the credit. They cannot be different. Whatever goes to debit, same amount goes to credit. We're going to see in a second how we're going to do this. Now, journal entries. On the journal entry, again, we're going to have the date of the transaction, accounts involved, title of the accounts, which account we debit, which account we credit, and the amounts that we debit and credit. And sometimes the explanation is needed, sometimes explanation is not needed. On the questions, we're going to simply say when you have to provide explanation, when you don't have to provide the explanation. So once we have all the transactions posted in the accounts, we're going to put all those accounts in our ledger. And once we get the ending balance of all the accounts that we have on the ledger, we're going to have our trial balance, which is going to look like something like this. Before we go to the trial balance, let's cover something else. Why do we doing this way? Because the financial statements of the company are a result of anything that happened in the company through the operation of the company for the period of time. If there's no time, nothing's going to happen. We're always going to have the starting point. Starting point will be the starting point for the company. Then we're going to have transaction. When the transaction happened, the starting point will be the recording of that transaction. Now, once we receive the document, first thing that we have to do is to answer the question, is this transaction presents a financial event that should be recorded in the company accounting ledger? For example, owner of the company bought a diamond ring for his fiancée for $50,000. We have the receipts from Cartier. We have the name of the item. We have the how many carats the diamond ring is, what's the quality of the diamond, what's the clarity of the diamond, everything. Next thing that we're going to ask, is this should be recorded on the company ledger? No. It's a personal expense. Do we have to continue? No. But if the owner buys a diamond ring or buy diamonds on bulk because he's a jewelry producer who's gonna make the diamond rings and we're gonna start selling it to the other people so that when they buy rings to their fiancés, then that's changing the whole perspective. Now the owners buy diamonds on bulk. Is this part of the business? Yes, it is. Then we have to recognize it. If the transaction is recognized, then we're gonna put it on the elements of the financial statements. Either it's gonna be asset, definitely it's gonna be asset because it's gonna be inventory. And then we're gonna see if the owner pay for those diamonds or he has to pay for the diamonds. If it's has to pay for the asset, the diamonds, that will be liability. If he pays for the diamonds, that's gonna be reducing another asset. So again, the posting is going to happen in the 3 columns. We're going to have those columns. Again, first is the date. Then we're going to have account name. Then we're going to have the posting reference. Posting reference can be related to the account number. Cash is always the most liquid. So always going to be the lowest number with number one starting. As you can see, the next account is 3,000. 3 is related to the equity. Then we have another transaction starting, the account starts with 1, that will be land since it's asset. And another transaction, another account with 1, which is the cash. And you're always going to have debit, credit, debit, credit. Always debit equal to the credit. Then we're going to go to the ledger. In the ledger, we're going to see the summary, what happened in the account. Money coming in, money going out, balance. And that balance is going to be the one that's going to be flow to the trial balance. What do we need the trial balance for? To tell us all the balances of all the accounts that we have in the company, either liability, either equity, either revenue, either expenses. We want to see everything on one sheet, on one place. So the trial balance simply going to summarize the ledger using all the accounts with only the final balances. On the ledger, you can see debit and credit. I'm going to show you the ledger. When we go to the class, I have a ledger in my room, and I'm going to bring it to the class so you can actually see the ledgers from the actual accounting. Again, assets will be first, liability will be second, owner's equity will be third. Then we're going to have revenue accounts and expense accounts, and that those will be in that order. Long time before the computers was created, people using it was people. When I say people, I was using trial balance. Believe it or not, uh, there was a time in my life there was no computers. Probably not in your lifetime, but in my lifetime, there was a time there was no computers, people. And the first time that I had experience with the computer, that was when I was the first year in the engineering university. Yeah, believe it or not, I didn't start with the accounting first. That wasn't my first choice. My first university, I was actually studying in the engineering university. I supposed to be engineer. I supposed to create internal combustion engines. That was my high school. But when I went to the technical, that engineering university, the knowledge that they gave me was way, way, way below that I expected. And basically, in the first year, I didn't learn anything, so I found it useless for me, and I dropped it, and I moved to the accounting. But yeah, the idea is for me to create internal combustion engines. That's my specialty from the high school. But the high school was super specialized, and there's no that equivalent anymore. I would say there's no equivalent like that in North America, neither of my country of origin anymore. That was very, very. Those was for the top students in the city, and the class was only from 18 people. That was the maximum. That's how they keep it. That class was 18 people, and yeah, in order to qualify for that, actually, they were like in my home city, where I was born. In my home city, we have like a 12 high schools, mid schools. Let's say mid schools, 12 mid schools, and from those 12 mid schools, um, students or the students on those 12 schools applying for those 18 spots for that high school. And in order to get there, you have to have pretty much perfect A plus diploma from mid school, which I had. And then you have to go to the entry exam on math, which I did. And you have to perform a score, and only the top 18 getting in that class of 18 people. Yeah, that's so basically the level was super high. And yeah, that's but that was the time. And after that, I went to that engineering university. And in engineering university was the first time that I saw a computer. And if I show you that, probably I'm going to be able to find somewhere the diskettes that we use. Probably if I say diskettes, you're going to say, what is this now? And also was the floppy diskettes, the very, very, very first floppy diskettes, which was kind of soft and was a big, look a little bit bigger than the envelope, which you plug in. The maximum capacity of that diskettes was 325 megabytes, people. That was the maximum capacity of that floppy disk. Amazing. So where we are now with capacity that one USB can hold up to 1 gigabyte. Yeah, that was the reality. But yeah, on that time, people are actually doing the trial balances on the paper. And trial balance is useful summary of all the accounts on one place. So it's going to look like this. So you're going to show you everything that you have on one single sheet. How much cash, how much you have to receive from the customers which haven't paid you, how much of its supplies you have, what's the land that you purchase, how much you have to pay for the liabilities, outstanding liability that you currently have, how much of those money that all the assets belongs to the owners, how much the owner's capital is, $250,000, how much the owner withdraw from the company, $6,000, how much revenue company generating up to April 30th from January 1st, $55,000. How much they spend for the rent expense, salary expenses, utility expenses, that much. Debit always going to be equal to credit. Why? Because asset is always equal to liability plus equity. And also when we're doing the double entry, debit is always equal to credit. That's why I like accounting, because nothing is hidden. In order something to come, to have something, it has to come from somewhere. There's always equality in the equation. You have laptop because either you pay, either you have to pay, either because somebody invested in you. There's no other options. So, mistakes. How are we going to correct the mistake? If we see the mistake in the trial balance, so basically what says is you're looking at these totals. On one side you have one amount, debit. On the other side you have different amount. How are we going to find a mistake? How are we going to lie? The most common mistake is transposition error. What means transposition error? Flipping numbers. How can you find transposition error? Now, I'll tell you something that kids usually study in grade 3 or grade 4 in some countries. On the transposition error, just give me a second. I want to make some adjustments on the Excel spreadsheet, and I'm going to move you now to Excel spreadsheet. Okay, so let's say we have this trial balance with different accounts. So our debit and credit have a different amount. So total debit, let's say, is 67890, 67,980, and our credit is 68,790. As you can see, the amounts are different. They're very close, but they're different. So what's happening is they're a flip number. How can you find out if it's a flip number? Very simple. Get one account, get the difference between the two amounts. This one minus that one. The difference is 900. So what that means, we have here, if you break it symbol numbers, you break it to the symbol numbers, getting 9 plus 0 plus 0. Total is 9. As long as total is 9, transposition error. Another example. Let's go with 54723. And let's go with 54273. So what we have to do, we have to see the difference. The difference here is $450. Well, let's break it simple numbers. That will be 4 plus 5 plus 0. Total 9. Transposition error. End of the story. So what you're chasing is flip number. And we can keep going with this. We can go with, let's say, 51 and 15. Now, how much is the difference? Difference is, sorry, is 36. So we're down to 3 plus 6. Total is equal to 9. Transposition error. That's how easily you can find a transposition error. Okay, so we're done with chapter 2. That concludes chapter 2, the slides. But we're not done for today. What we're going to do from this point? We're going to start doing some practice. Now, before we start doing the practice with the questions debit and credit, I want we to go some very light basic stuff. What is that? That is we have some questions from chapter 1, from the first class, which I want we to go over. But before we go to those one, I want to see the questions first and select not very selectively to go over those questions so I can build up the proper foundation for you. So let's go with the questions from chapter 2 that I have for you. Those questions, now let me see if I already posted in the Blackboard. Just give me a second. I want to check those questions, are they already in the Blackboard? If they're not, I'm going to post those one after the today's lecture, and you're going to have them available. I believe I did, but let me double check on that. We're on section 5. No, I haven't. So I'm gonna post those one in today after the lecture. I'm gonna post you those questions. They're gonna come right here. Let me show you where they're gonna show up. So all the questions that we're gonna do is gonna come right here on the chapter 2. At the very end of the chapter 2, you're gonna see practice questions from class. And I'm gonna post those one there. So now let's start with the first one that I have for you today. And let's go very quickly over this question. Or maybe we can slow down. How is the speed so far? Am I going too fast or am I going okay? Okay, okay, just about right, that's good. Thank you for the feedback. Now let's see this question. Now, I'm going to show you different accounts. Now, what you have to identify, you have to tell me if the accounts belong to the asset, if the accounts belong to liability, if the accounts belong to the owner's equity, if the accounts is withdrawal, is it revenue, is it expense. Now, the simple basic rule, every time when the account says payable, most likely will be liability. If the account says expense, most likely will be expense. There are some exemptions. I'll show you the exemptions. But again, if it says payable, most likely it's liability. If it says expense, most likely will be expense, unless it's prepaid expense. If it says prepaid expense, that's a liability. Everything that, that's asset. Every time when you says prepaid expense, means that you pay something in advance and you haven't received the service or the goods yet. So anytime before you receive the goods and services, you can cancel that services. So technically they owe you money. So that, for that reason, that's asset for you. Having that in mind, let's go one after another. Buildings. Those are the options you have: asset, liability, owner's equity, withdrawal, revenue, expense. What do you think building is? Assets. Any other suggestions? Only two people? Is there anyone who wants to also get involved in this discussion besides Vincent and Mo? Okay, buildings, asset, good. Let's go with the building repair expense. Again, every time when you see expense. Okay, let's go with the next one. Wages expense. Good. How about wages payable? Good. Not receivable. Now we have to get something from people. That will be asset, yes. How about notes payable? Clearly liability, correct. Now, prepaid advertising expense. I purposely is going to add this expense here. That's an asset. Every time when you see prepaid override the expense and make it asset. Remember that. Now, advertising expense. Now, it doesn't have a prepaid in front, so pure expense. How about advertising payable? How about, now careful with this, unearned advertising fee. Let's go with fee here. Yes, that will be liability. That's tricky one. But it's unearned advertising fee is a liability. Why? Because we haven't provided the service yet. We technically, we get the money, we owe the money to the people. How about advertising fees earned revenue? Yes. No questions about it. Once you see earn or you see a fee without expense, that's a revenue. Interest earned or interest revenue. Revenue. Correct. How about interest expense? Okay. Interest payable? Earn subscription fee. Okay. Revenue. Revenue. Clearly revenue. Now, the unearned subscription fee, it will be the one that you're saying liability, right? Here we earn them. That means we provide the service. It's pure revenue for us. Here we haven't earned it yet, right? Prepaid subscription fee expense asset. Clearly asset here. Supplies. Okay. How about supplies expense? Expense. Rent revenue. Now be careful with the next one. Unearned rent revenue. Right? So now here we can put earned rent revenue. Once you see unearned, definitely liability. 100% liability. Prepaid rent expense. Prepaid rent expense. Prepaid rent expense. Again, remember, prepaid override expense and make it live asset right away. Why? Because we haven't received the rent yet. We pay for the rent, but we haven't rented the space yet. So technically, we can ask for the money back. We can say, no, I'm not renting it. Give me the money back. We're going to talk more about next time about those prepaid and unearned, and you're going to see the differences more clearly. Rent payable. Service fee earned revenue. Owner's withdrawal. That's purely withdrawal account. Owner's capital. Capital account or equity, right? Salary expense. Expense. Salary payable. Furnitures and equipment. They're all assets. Good. Good. Let's see now. Let's go one step ahead and let's see how you're gonna respond to this one. Now on this question, let me see what you're seeing. You still see the previous question. Let's close this one and let's go with the new question. So now on this question, what I want you to do is first, identify which part of the balance sheet or income statement is, and what is the normal balance for this account. Let's go first one with the equipment. First, what kind of account is? Asset, liability, equity, revenue, expenses. And if it's that one, okay, asset, what's the normal balance? If it's asset, what will be the normal balance? Debit or credit? Debit, okay? Excellent. Land. We have a land. Asset, okay? Normal balance. I want to see more people involved here. Okay, debit. Let's go with the owner's withdrawal. Now, before we jump with the credit, so the owner withdrawal, remember, first it's a withdrawal account, right? Now, what's happened with the owner's withdrawal? If you put it on the debit side, increasing. So the normal balance for the owner's withdrawal will be debit. It's not credit, it's going to be debit. Why? Because on the debit side, decreasing the owner capital. On the credit side, it's going to increase the owner capital, but the withdrawal is something that naturally is going to decrease in the capital. Yes. That is correct. Owner, the withdrawal decreasing owner's capital. So for that reason, normal balance is debit. It's not owner's equity. It's part of the owner's equity, but every time when the owner taking money from his capital, he decreasing his capital. Make sense? Think about it. Owners withdraw $100. No, first we're gonna see how much he's invested in the company, but then he start taking money from his company. So withdrawals always gonna be reducing his capital. So for that reason, remember it. Withdraw always gonna be with debit balance. Accounts that increasing owner's capital is going to be credit, but the accounts that decreasing the owner's capital will be debit, right? So which account decreasing the owner capital? Withdrawals first. Second one is the expenses. That's why expenses have a debit balance. Which account increasing the owner capital? Investment, revenue. Those have credit balance. So let's see, one owner's withdrawal, remember it, withdrawal account, normal balance debit. A rent expense. What kind of account is that first? Expense account, yes. Normal balance. That one reducing the owner capital. Debit, yes. No questions, there shouldn't be no questions. So one thing I want to make it clear, expenses, always debit, no questions about it. Revenue, always credit, no questions about it. Don't mix them. Expenses, debit. Revenue, credit. Revenue, money revenue. Increasing the owner capital, good for the owners, credit. Expenses, bad for the owners, reducing the owner capital, debit. Interest, revenue. What kind of account is that first? It's a revenue account, so the normal balance will be credit. Prepaid rent expense. What kind of account first is that? Asset account. Normal balance will be debit. Accounts receivables. What kind of account is that first?
Debit.
That will be normal balance, debit, but it's asset account. Correct? Let's go with the not receivables. What kind of account is that? Asset account. Normal balance, debit. Not payable. Liability account, okay. Normal balance, credit. Owner's capital will be equity account. Normal balance, credit. Rent earned, we can add here fee, rent earned fee. Revenue account, yes. Normal balance, credit. Good. Rent payable, liability account, yes. Normal balance, credit. Correct. Next one. Interest expense. Expense account, yes. Normal balance. Why not many people are involved here? Get me more, give me practice. This is the free environment. I want to see how you're responding to this. Interest payable. Liability credit, yes. Good. Good. So now let's make it one step harder. And let's think about it now. Once we know what's the normal balance of the account, let's see what is going to decrease and how can we increase something and how can decrease something. Now, remember, first, before we start, if we on the asset account, debit increase the asset, credit decrease the asset. If we on the other side of the equation, on the liability and equity, credit increase liability and equity, debit decreasing the liability and equity. If we have expenses, debit is going to increase the expenses. If we have a revenue, credit is going to increase the revenue. Let's see now. We want to increase not payable. First, what kind of account is this? Asset, liability, equity, liability. How can we increase the liability account? With credit, correct. Now, we want to decrease accounts receivable. What kind of account is account receivable? Asset account. How can I decrease asset account? With credit, correct. Let's go to the next account, owner's capital. Should the asset account increase? Should asset account increase owner's capital? Asset account increase copy. No asset account, it's gonna increase the capital, but in certain circumstances, if the owners invest money, that's what's gonna increase in the capital. In two general questions, two kind of tricky question, we're gonna see different instances that increasing the asset not always increase owner capital. Right? Two other things have to happen in order that to be true. You cannot simply say yes, no. So let's leave it for now, this question. We're going to see later how exactly that's going to affect. Usually it can happen, but there are other things that can also increase the assets. And it doesn't always have to be owner's capital. It can be liability. Liability also can increase the asset. Right? What we're going to see going forward. So let's go with the unearned fee. That's a liability account, correct? How can I decrease a liability account then? Owner's capital is equity account. That's correct. But the question was, increasing asset doesn't is it not increase owner's capital? There might be instances that is correct, but not always. Let's go with the next one. Prepaid insurance expense. What kind of account is that? Asset account, correct? How can I decrease asset account? Good. Very good. Let's go a little bit further. Cash. That should be fairly straightforward. Cash is asset account, so we can decrease it on the credit side. That's correct. Utility expense. Since it's expense, debit side. Yes, that's correct. Fee earned. Fee earned. Careful. It's a revenue account. Yes, It's not asset, it's a revenue account. And increase credit side. Correct. Store equipment. Asset account, great. I want to increase it. Debit side, correct? Owner's withdrawals. Withdrawal account, how can I increase it? On the debit side, correct. Good, very good. Rent payable. Liability account, correct. It's payable, correct. I want to decrease that liability account on the debit side, correct. Prepaid rent expense. I purposely putting this expense because that's a prepaid expense gonna come on your first test. And decrease, how can I decrease it? On the credit side, correct. Supplies. Asset account, okay. I want to increase it. Debit, I have to add on the debit side, correct. Supplies expenses. Expense account, okay. I want to increase it on the debit side. Good, very good. Accounts payable. Liability account, okay. And I want to decrease it now on the debit side. Good. Very good. Very good. So at this point, do you want break or go with another question? Let me see what you're telling me on the chat room. Okay, let's have a break then. And we're going to continue with now actual debit and credits. Second lecture. You're doing great. For the second lecture in accounting, and if you actually understand and processing everything that I'm giving you, you're doing phenomenal. Good job. The only thing that left now is we to practice more. And we're gonna practice more. That's the thing. I don't want you to remember. Remember what I'm telling you. I don't want you to remember. I want you to understand and think what I'm getting, what I'm giving up. Am I giving up assets or I'm getting more liabilities? Remember, nothing comes from nothing. If there's effort, there's a reward. If there's no effort, no reward. If there's a reward, you're gonna get either you're gonna get cash, either you're gonna get fame, whatever you're getting. So you earn it, you're getting it. It's always like that. Whatever you give, that's what you get. Now, what you get and what you give. As you can see here in accounting, you can get furnitures, but you're also getting liability. Is it good for you to get liability? That's a different question, right? Some people can live all their life on the liability. We're going to go to those points a little bit later, and I'm going to ask you the interesting question. Remind me to ask you that question related to liability, if I forget to ask you at some point. But remind me to ask you that question for the liability, and I'm going to give you a different perspective. So if it's personal purchase, it's not recorded in the business financial statement. If Mary purchasing wedding dress, it's not reflected. So is this part of the business? Let's look at the, so watch this. Let's stay with the case facts. The case fact says this company providing support to customers in area of e-commerce is buying the wedding. How the buying the wedding dress we're gonna help our to support our customers in area of e-commerce. If you can prove me that buying wedding dress, it's gonna help us to provide better support for our customers in the area e-commerce, I'm gonna buy it as a business expense. But if you cannot prove it, it's clearly not part of the business. If it's not part of the business, can I deduct it as a business expense? No. Question for you. If you're going that direction, I'm buying McDonald's coffee. You're my student. We are related. Who's going to pay for the coffee? Is it part of the class activity? Well, but I'm bringing the McDonald's coffee to the class and helps me to provide better service to my students. Is the McDonald's coffee for the benefits of my students? Right? Do you understand where I'm going? I can I can push it that direction, right? I can push it in that direction. And at the end of the day, I can say, you know what? Besides the cost of the course, you have to pay for my coffee as well. Why? Because it's part of the delivery in the lecture. Is it part of the delivery of the lecture? Technically, it's not. Right? Right now we can go with the school expenses and we can put it in the school, but is it part of the school expenses? It's not. Make sense? So stay with the business. Stay with the business, look at the business, uh, watch is how this expense help the question that you should ask. Yes, you can deduct the expense as long as the expense help you to generating the revenue. If the expense that you're doing doesn't help you to generate the revenue, I'm sorry, it's not part of your business. Because at the end of the day, you want to see how much my business earn, how much I'm generating from the business that I'm doing. I don't want to see how much business, how much, if you want to keep a different calculation, how much business pay for your wife expenses, that's different calculation. That's different accounting, but that's not accounting part of the business, right? That's how you should put it, clear it in your mind. But good questions. Thank you. Good questions. Thank you guys for today. Enjoy the rest of your day. Have a great long weekend. I hope you're enjoying those lectures. Recording will be available for you after I close this Zoom. So you're going to have it available in the section of the recording. And also this Excel spreadsheet will be available in the cases for the chapter 2. Again, thank you. Enjoy the rest of your day. Have a great long weekend. Have a great week next week. And we're going to hear each other again next week. We'll be online for one last time, I hope. Same time. Thank you. Do I have here students who's waiting for registration? Is there any of you who has to talk to me? Send me email from the waiting list and waiting for registration. Or no?